Hey everyone, it's day one of the lockdown and I'm home. Hoping you guys are too. I thought I'll take this chance to start recording some lectures. And yeah, let's see how they go. I'm going to try do it in this format whereby you'll see the slides and me the whole way. We'll see how it works. And yeah, let's go from that. So what we're going to be looking at today is the issue of donations tax, and we've spoken about it a little bit in class, but I think what's important is that we have to look at the idea of donations tax in context. Now, that context, I'm realizing you can't see my hands, is very different from the context of normal tax that we've done before, very different from VAT. This is also something very different from your Section 18A deduction that you get for donations to PBOs. Donations tax is a separate tax on its own, and it's a tax that's levied on donations. So if you make a donation to somebody else, like you give them a house, you give them a car, whatever it might be, there is a tax on the transfer of that wealth. Now, straight away you may be thinking, well, that seems a bit weird. How does SARS have the right to just tax us on, giving birthday gifts to somebody, or a parent giving a car to their child, or something like that? It just seems a bit off, doesn't it? Now, to make sense of this, we need to go back a little bit and talk about estate duty. I'm going to do estate duty after this, but I think it's best to talk about what estate duty is as well. Now, SARS needed a new way to make money. They thought, who can we tax? The best person to tax, might sound morbid, is somebody that's dead, because they can't really fight back. So what SARS did was they said, cool, we're going to levy a tax called estate duty. And what's going to happen is when you die, the value of everything that you have is going to get added together, and then they are going to tax you on basically the value of your wealth. Make it a bit bigger so you can see me. Now, this worked, but obviously you can imagine if people knew when they died, SARS would add up the value of everything, put it together, and levy a tax. Now, that tax is at 20%. So the value of everything you own, less certain exemptions, certain limits, times by 20% is a tax that you have to pay. And that seems quite heavy. So what did people start doing? They realized, well, hey, if I don't own it when I die, it's not going to be included in the estate duty. So anybody that was old, anybody that was sick, would start donating all of their assets to their family members before they died, so it wouldn't be subject to estate duty. Now, straight away you can see that's a problem, because what happened is people started simply donating everything away, and estate duty didn't become a very effective tax. So what SARS said was, and for other reasons, if you donate assets to somebody, you're going to pay a tax on that donation. And how would you have it? That is 20% as well. So it doesn't make a difference if you keep it and die, you'll pay the 20%, or if you give it away, you'll actually pay the 20% earlier. It also helps combat things like spouses or friends or family transferring assets between each other to split the income streams. Because remember, two smaller income streams will be taxed less than one big one. So it helps for situations whereby you might transfer assets to family members, maybe somebody that's not working or somebody that's young, to get them to have the income so that they don't pay tax, and they just give it the income right back. In this case, there'll be donations tax. So this is what we're trying to avoid. Remember, this is a tax on its own. It's not linked to any of the other taxes, so you have your own calculation for donations tax. And yeah, that's pretty much what we're looking at. I'm going to switch back to small screen for now. You'll see we find ourselves in the Income Tax Act, but it's got its own little section at the end. And it's found in sections 54 to 64 of the Income Tax Act. Now, how we're going to look at this is we're going to go through part by part from 54 all the way up to 64. We're only going to look at the relevant sections, and we're going to see what donations tax is all about. Now, general. It's a tax levied on the transfer of assets or wealth. So it's when you have one asset going to another person. That asset could be in the form of physical assets, it could be in the form of intangible assets, or it could be in the form of cash. There's no exemptions based on the type of asset. Donations tax applies to all three: intangible, tangible, or cash. Now, the basic principle: any donation you make is subject to a 20% tax. You can see it over here. What that means: you donate 100,000 Rand to somebody, 20% of that has to be paid over to SARS. We'll look at how it's paid and who has to pay it later. But it seems quite steep, doesn't it? But that's how it works. 20% of anything you donate is going to be given to SARS. Actually, even something that came in 2 years ago, you'll see over here. In your lifetime, although in this case after 1st of March 2018, because that's when the rule came in, once you've donated 30 million Rand in total, so it's not per year, that's over your period from the 1st of March 2018, if it ever becomes more than 30 million, any subsequent donations are at 25%. Okay, we'll look later, that's linked to a change in estate duty as well that says for any large estates, that'll be at 25% too. Now, how this amount is paid? Well, basically, whenever you make the donation, and this goes donation by donation, you have to, what I mean by that is it's not added up for the whole year. You have to do this whenever you make a donation. And how it works is you have to pay that money over to SARS, the 20%, by the end of the month following the donation. So if you make the donation in August, you have to make sure it reaches SARS by the end of September, regardless of when you made it in August. So you will always have at least a month, but you may have almost up to 2 months to make it if you had made it in the beginning of the month. Okay. Some things to note: it's only levied on South African residents. It doesn't apply to non-residents, even if they donate South African assets. Okay. So it only applies to South African residents, and it applies to any asset that a South African resident donates, but it does not apply to non-residents, regardless of the type of asset. Okay. Now, note, Section 59 tells us that this 20% is payable by the donor. The donor is the person who is giving the asset or the money. The donee is the person who is receiving it. Cool? But what happens if the donor fails to pay? What we know is that the donor and the donee, in terms of law, are jointly and severally liable for the donations tax. Now, just careful on the words there, jointly and severally. What that means? They are both liable. So if one doesn't pay, the other one has to pay. And then they can fight amongst each other about, getting the money from who's supposed to give it. But SARS, if they can't get it from the donor, will go after the donee. So if you're getting some kind of asset and the donor doesn't pay, you got to think about, hey, maybe I actually have to pay it. If you want to pause here and link what we did in CGT, remember that the person who incurs the donations tax is able to add it to their base cost. There was a formula: if the donor add it to their base cost when they sell the asset or when they donate the asset, because there'll be CGT. And then if you're the donee and you pay it, it's an expense in acquiring that asset, so you can add it to the base cost. Just remember, it would be the only cost, because if somebody is selling it to you, it's not going to be a donation. So there wouldn't be donations tax. This is only going to arise in situations whereby you don't pay for the asset, or you pay way too little for the asset. In this case, then if you pay the donations tax, you can add it to the base cost. Little story, because hey, you still need stories while I'm giving you the video lectures. I think I've told you this, but for quite a long time, said it was jointly and severely to all my students. And they used to always laugh, and I never quite figured out why. And then I thought about it one day, and I was like, well, why does it say severely? It doesn't really make sense. And I realized it was actually severally, which just means together, not severely as in, hey, this is pretty harsh and rough. Okay. Now, a real life situation. Again, we had spoken about this in class briefly, but think of a situation in a game show or something like that, whereby if you win the game show, you get 1 million Rand. Now, what happened in Idols was the two final contestants decided to speak to each other before the winner was announced and said, hey, why don't we actually just, regardless of who wins, split the money half-half? sounds like a good idea. But you got to think about the tax consequences. And the tax consequences would mean that, hey, whoever won, the full R1,000,000 is going to accrue to them. They're going to have to pay tax on it, okay, depending on if it's gross income and all those things. And they'll pay tax. And then they donate the other 500,000, but there'll be that 20% donations tax. So you're going to have person one paying up to 45% on their gross income. Plus you're going to then have a 20% tax to get it to the other person. So actually at the end of the day, there's not going to be too much money left. So you'd have to think about how the tax works in all these situations. You also have to think about, just extra here, is this actually going to be gross income if somebody was to win idols? I'm not fully sure. You'd have to argue, is it, for services rendered? Why did they win it? Was it fortuitous gain? Was it because of the work? I don't really know. My guess is probably you'd have to pay tax, but I'm not certain. You could argue either way. I said to you in class, remember the guy who won the first Survivor? He went to jail actually for not paying tax on his winnings, which is quite a scary scenario, but not relevant here. Now, when you look at sections at the end of the Income Tax Act, 54 to 64, if I remember right, there's some defined terms. The key one in 55, the term donation. Now, what does donation mean? It means any kind of gratuitous disposal of any property or gratuitous waiver or renunciation of right. What that means, the keyword here is gratuitous. Think of the word gratuity, a tip, something that's not required. In this case, what it means, provided, where did my mouse go? There we go. Provided without payment or return, i.e. it means you're giving this, but you're not getting something back. Okay, so donation does not mean I sold something to somebody and they paid me. If there's a two-way transaction, that's fine. A donation is one person giving something, whether it be an item, cash, service, intangible, to somebody else, and that person's giving nothing in return. Okay. As I said earlier, the term property, it includes anything movable, immovable, corporeal, or incorporeal, including any rights to any of these things. Cool. We then move on to section 57. And 57 is just a little specific section that actually says, hey, well, what a lot of people did was they would say, great, I might be South African resident. I'll set up, a foreign company, and I'll get them to make the donation instead of me. Now, what this says is, hey, any donation made by a body corporate or a company or anything like that, and it's not in the ordinary course of their business, and the donee was selected, whether it be directly or indirectly by any person. So basically, if you can control a company to make a donation, that's not what the company normally does, and you can pick the person. This specific section just says that, hey, the effect of this is that that donation will be made by the person who chose. That person will be liable for donations tax, and that donor, if required, can fight or try claim it back from the company, but that's between them and the company. All this is basically doing is trying to stop people making donations through companies rather than making it on their own. All it says is if you can control the company and you choose who it's donated to, it's going to be from you as a person and not from the company. Okay. You can see a question at the bottom, and unfortunately it's going to be slightly cut off. What it says is, what if the company is non-resident and the person is resident? Well, the person's the one who's going to be deemed to be making the disposal. Therefore, there will be donations tax. Okay. Spouses, I think I'm going to leave this because I'm coming up to the 15-minute limit. I think I'm going to leave this for now, but the key things to take away from what we've done so far, just remember we're looking at donations tax. Know where we are in the Income Tax Act and what kind of tax donations tax is. Know how it links to estate duty. Know the basic rates. Know when it's payable. Know who has to pay it and who's subject to donations tax. Okay. Lastly, make sure you know what a donation is. Make sure you know that it's a gratuitous disposal or transfer of assets. And yeah, that's where we're going to leave this one for now, and I'll pick up in part 2.